On this computer machine. All right, so we started the recording and we are just going to increase the zoom a little bit and find out where we were. We were looking at decision problems in hedging passive risk books. So we were going through the decision problems. We looked at the listing of decision problems, and then this is what you did in the case of the investment funds that you looked at. A couple of investment funds that you ran. One is using options and one is using spot equities. One is using equity options. So let's look at this now. When we look at managing a passive risk book, what happens? This is where we were. That this is what we were discussing the other day, right? Maybe we can make it even a little bit. This is fine, I think it's fine. Here, sizing problems. Let's try to make all this within one. All right, in one line, if we can. All right, so this is what we were discussing here. So what we showed you in the last session is that the DP4 problem is automatically solved because if, in this case, we are talking about a hedging program, okay? You're managing a passive risk book, so which means you're running a hedging program. And we have just talked about a static hedging program, which is hedge and forget, which means you hedge it only once. And we're taking a simple example to understand the decision problems and which of those, the nature of those decision problems in this new type of context of managing a passive risk book. And to understand the nature of those decision problems, and in particular, the question that is asked in the case, that here the CEO has asked is question number 3. The CEO is familiar with these decision problems, and he's wondering which of these decision problems are automatically solved and which have to be actively solved by the hedging team. And then
share your screen, sir. You didn't share.
Sir, have you shared the screen?
Oh, yeah.
The share your screen.
Good. See, this is what. Yeah, see, I forgot about that. I forgot about the screen share. Okay, let me then quickly. Yeah, I think the audio is captured, so you've seen that. So whatever I said just now, whatever I said is related to these. What I was talking about is that we had discussed we laid out the decision problems that apply to managing an investment fund, which is an active risk book, and then we talked about this should be written as a active risk book. Investment fund is an active risk book. Okay, just repeating a little bit. Instead of passive risk book, we will just copy this and say that this is what the CEO is talking about. Yes, Sachin?
Sir, this question not related to the topic but there is a GME share. It is in your tab. Sir, this share will increase almost a 300%.
Yeah. We'll come to that. That's why I've not written it as, I didn't discuss it initially. This is GameStop. Okay, so there's a lot of activity around it. A lot of things are happening. So Utsav had a question about it. We'll come to it at the end of the class. Okay, just remind me once again, if Utsav is not there, you remind me at the end of the class. Okay, I don't want to interrupt this discussion because it's not related to our discussion. So it's a separate matter, but it's an important matter. So we should, this is a good habit that it's a good thing that at least 2 students in the class are aware of what's going on in the US equity markets. This is exactly what we want, that more and more people should be totally immersed in the markets. And that's how you learn, okay, as to you learn what is actually happening in the markets. So this is very important. So we'll do that after the class. We'll have a short session and then I'll have a full session later on. So what we were discussing, what I discussed initially when we started the class, it's just 8 minutes in. Okay. Is that we have, where was I? Yeah. So this is an active risk book, the investment fund. which you have done in your first two projects, managing a book of US equities, spot equities, and managing a book of US equity options. Those are active risk books. Now you've come to a passive risk book where you have to manage risk for for Magma Resources, which is running which is a commodity and energy company. And they have all these positions on their balance sheets, these are the underlying positions. And then you're supposed to, without disturbing the underlying positions, you're supposed to manage a hedging program which will protect this company's net worth from being eroded by market fluctuations. All these KRFs are fluctuating rapidly. The prices in these KRF markets are fluctuating rapidly, and they are therefore affecting the market value of assets and liabilities on the balance sheet. And your job is to anticipate what is likely to happen in the market and accordingly take remedial action in the hedge book so that it will offset the losses on the underlying positions, okay, from the market movements. That's your goal. So that's what we're looking at. So what we are saying is, in the context of this kind of problem, we also want to do a little bit of theory to understand, in particular, how are the decision problems that we encountered in managing an investment fund, how are they modified in a risk management context when you're running a passive risk book, in a corporate treasury risk management context. How are they modified? And in this regard, what we covered the other day, this is all in the nature of a recap, but we are still within our 10-minute limit of starting, so we are quite okay. Right. So what we had covered in the other class is that this buy-sell decision, which is a big problem in an active risk book, solving this decision problem, this is automatically solved because the sign of your underlying position determines what you have to do here. So if in the case of gold, if you're long, when you're managing gold, what will happen here is that the question of buy-sell when managing the hedging program, this question of whether I should have a buying bias or selling bias, this question doesn't really is automatically solved because since my underlying position in gold is long, therefore my hedge position has to be short. So the hedge transaction that I have to do will have to be a sale. It can't be a buy. It'll have to be a sale because a hedger must always reduce his risk. Okay, he reduces total risk with his first transaction. This is what we discussed yesterday. This is the rule that we discussed in the previous session. Okay, so this is the rule. So that's what we discussed. So I'm just recapping. This is all repeating actually, but these are important things since you're actively attending the classes live as well. So it does not hurt to have a little bit of repetition. If it was a purely asynchronous course where you would only listen to the video lectures, I would not be repeating all this stuff because it's already covered in the previous video. So DP4 is covered, is automatically solved. But what we also saw is that, okay, so this, we will come to this DP4, this part later. But what we were discussing is DP5. That DP5 is actively solved, is to be actively solved. Because once again, if you go back to our example where we looked at gold, okay, so we started the example of gold. Now we know that DP4 was automatically solved because I look at my underlying position. This is appearing on the asset side, okay. So, and there's a positive value on the asset side. So this means this is long. This is a long position. It's in my inventories. So my underlying position is long. Therefore, my hedge position has to be a short position. And therefore, I have to be selling gold. That is clear. But as far as DP5 is concerned, it is to be actively solved at this. What is the entry price? Is it at the market? Is it at a price better than the market using a limit order? Or is it at a price worse than the market using a stop order? When we say market, we mean the current market price right now when we are talking about the decision problem, right? So we look at this, the entry price. This is what we were saying, that if we go to gold, let's see what we have, the CFD. Yeah, we have the CFD. We don't have any wind-up prices. Okay, as I said, US dollars per ounce. Please no, look at this gold price. Don't look at the Indian gold price. Okay, that's 5 minutes is not good enough for us. We have to look at least, let's say, 5 years. And we look at this gold price here. Okay, so this is where we are. And now the question is, I know my position is long, so my hedge transaction has to be a sale. I know I'm going to be a seller of gold. Now the question only is, should I sell when we come to DP5 and we are trying to figure out whether it's automatically solved or actively solved? When I come to DP5, there are three options that I have. I can sell immediately at the current market, or if I feel this is going to like maybe 2100 or something like that, okay, whatever. Here we can't see the scale, but if it's 21, this is already 2000, so it must be higher than that. 2100 would be higher than this. So if I feel that gold is going to shoot up right now to 2100, if that's my market view, then I will obviously not hedge at the current market, because why should I sell at this current price of 1841 if I think it's going to 2100? Okay, so that's the first thing. So in that case, what I would do is I would leave a limit order to sell at 2100, and I would monitor the situation. Okay, so that would be the first thing. So you see that there is an option here in terms of DP5, how we solve the for DP5, which is regarding the entry price. So regarding the entry price, and again, the other thing is, on the other hand, if your view is that the market is going to collapse right away, in that case, you will immediately sell it at the current market because you're afraid that the market is going to collapse right away. And that's the second option. And the third option, of course, is in that case, you use a market order in the case of the second option. And the third option is that you're not really sure what is happening. You think that it's probably likely to go up, so you're not hedging immediately. You don't think there's an immediate risk of losses, and you think probably it's biased to the upside, but you are concerned about a little bit about the downside. So what you might do is you leave a sell stop order over here, the previous low. So if the market goes through the previous low, this would be like another pattern of, high, high, low, low. So lower highs, lower lows, and then high here. This one did not go above this. And then if it falls below this, then you got a sequence of lower highs, and then you got a sequence of lower lows. The downtrend is already in place, and it will be confirmed further. So therefore, logically, you would leave a sell stop over here, because as the downtrend continues, there is a risk of further losses, and you know that your underlying positions are going to be losing value because the underlying positions are long. Okay, and remember that you cannot touch the underlying positions. The underlying positions on the balance sheet, these are all related to how the business is done, how the sales team sells to their customers, and how the production guys produce, the pace at which they produce. All that stuff, the underlying business dynamics, you cannot touch. But you have to recognize the risks that are arising from the underlying business dynamics. You have to watch out for the KRFs, and you have to monitor the KRF markets, and you have to be aware of your underlying positions. So therefore, for each KRF market, you have to be watching this carefully. In a large corporation, you might have one person managing each of the markets, but in your case, you have to manage everything yourself. So you have to watch each of these, and you have to keep taking views. And this exercise that you're doing, this has to be repeated constantly. You can repeat it maybe 3 times a day, or at least 2 times a day. And so this is the kind of frequency that you have to look at it. With which you have to look at it, because the market is always shifting. So the third option is that you leave a stop over here, which is in that case, relative to the current market, which is around 1841, if you get out at 1760 or something, that's worse than the current market, so less favorable than the current market. So in this case, you'll be leaving a stop order. So what we are establishing is that although DP4 is automatically solved, DP5 is to be actively solved. Okay, that's another thing that we are establishing. Now, as far as, if you remember when we had looked at, if you go back to the enumeration of the problems here, the font size is bigger actually. And the font size here is smaller. Okay, never mind. We will not disturb it because you guys can still read it, so it's still okay, I guess. Okay. So what we're saying is, now let's just go back and recap this element of the DP4, which we did not cover in the last class because this discussion was happening towards the end of the class, and the bell had already gone off. So if you remember when you looked at, as I showed you in the case of this is just a reproduction of what is there, right? So when we discussed DP4, we also made a note that in the case of in the case of certain types of instruments, okay? In the case of spot instruments, is all you've got is a simple buy-sell problem in the case of DP4, and that's it, you move on to DP5. But if you're dealing with certain types of instruments like futures, forwards, and swaps, you haven't really covered swaps yet, or even forwards, but you have some idea because it's very similar to futures. So when you're dealing with these kinds of instruments, there are certain additional DPs that are connected to DP4. So the question of buying and selling is not the only question in the context of DP4. When you've got other kinds of instruments, and especially if you've got options, okay. So in the case of futures, forwards, and swaps, you've got only one additional problem to decide, which is what is the buy-sell problem. When you say whether to buy or sell, then you also have to look at the yeah, right. Sorry. Right. So you've got buy sell here, but you also have to think about let's take the simple example of futures, forwards, and swaps. You have to think about the expiry. Okay, which expiry do you want to trade for? Okay, so for instance, if you have a whole bunch of different futures positions, like we looked at some of these types of, we talked about India's oil exposure. Okay, so if India has to buy all these quantities of oil. Let's say these are like 1,000 barrels of oil. In units is 1,000. Okay, so this is 500,000 barrels. I'm just giving an example. Okay, so if it's 500,000 barrels, 650,000 barrels across all these months. So one way of deciding how to hedge when you're talking about buy sell, one of the things you'll have to do is you'll have to specifically point out the contracts in each of the months. So like if we go here and try to get CME on futures. Okay, well, so basically the point is that when you're dealing with a problem like this, you're usually going to be looking at oil exposure for any kind of client, like in this case, you're managing India's oil exposure. You will typically lay out the exposure for several months in the future, and you'll be looking at this kind of a pattern, something like this. So in Feb, we have to buy 500,000 barrels. In March, we have to buy this much, and so on and so forth. And so then what you would do is you would look at the futures prices for each of these months, and you would accordingly hedge. One of the ways of doing it, there is another way to do it, okay, which we will come to later. But one of the ways, the simple way to do it, is to hedge against each of the specific months. So you would basically line up these exposures against the particular futures months, right? And then you would just, what happened? The page is still loading. I'm just trying to pull up the CME page. The page is still loading. So essentially, you have seen the distribution of futures prices for crude oil, right? So it is basically something like this. So it would be looking like this, right? So you would see your exposures. Okay, Feb, I gotta buy this much, March, April, etc. And then you would look at the Marches, the futures curve. This is called the futures curve. And then you would say, okay, let me buy this April contract. Let me buy for April, how much to have? 750,000 barrels. So it's 1,000 barrels per contract. So let me buy 750 of the April contracts. And how much do I have in May? I got 350. So let me take 350 of the May contract. So if you wanted to do an immediate hedge, you would basically hedge against, you would be hedging against the idea of at the DP4 level itself. You would be identifying the exposures and which months they are in, and then you would be accordingly looking at the futures curve and deciding the expiries. Okay, so what we are saying is therefore but this is not the only way to do it. There are other ways to do it, so that we will explain that to you later. But there is another way to do it. Instead of doing a perfect match against the maturities, there are other ways to do it. So therefore, what we will write is, the first thing you have to recognize is that there is actually a decision to be made with respect to expiry also. That at the DP4 stage, okay, there is always the question of buy or sell at the DP, the fundamental DP4 question, which applies for spot contracts. But in the case of futures, forwards, and swaps, there'll also be a question of expiry. That just because a particular exposure is in the month of April, you may not necessarily use the April contract for that. Okay, there could be other considerations because of volume. So therefore, what we have to just note is that, first of all, there are additional problems related to DP4 in addition to just simply buy sell that arise when you're trading futures, forwards, and swaps. That additional is expiry. You have to take a decision on what is the expiry of your hedge. Okay, so that's one decision. And then the other thing that we want to point out is that, especially when you're trading options, the additional decisions become even more actually. It's not just a question of buy sell. You'll also have to decide the expiry, as in the case of futures, forwards, and swap, but you have to also decide the strike. You have to decide whether it's a call or put that you want to execute. And then you have to also decide the exercise style, whether it's American style or European style. Okay, that will tend to get usually determined. If you're doing OTC, you have some flexibility, but there are still standard conventions in the OTC as well. These are connected to the instrument choice. Okay, so if you're choosing futures, there will be certain types of automatic choice of exercise style. Okay, if you're choosing forwards, OTC, again, there'll be some conventions. So there is a connection between this and the choice of instrument. But the point to understand is that this is also something that can be chosen, especially in an OTC context. Or if you want to insist on this, you can therefore avoid choosing exchange-traded instruments and go for OTC so that you have a flexibility on this. You can decide what you want, if this is very important. But usually this is not very important, exercise style, because the behavior of American style and European style options is not very different. So usually this is not a big factor, but theoretically you have to understand that this is an additional factor. So at the level of DP4 itself, while the basic buy-sell decision is automatically solved in a hedging context, okay, risk management. Hedging context, managing a passive risk book. The basic buy-sell decision is automatically solved, but there are certain additional decisions which arise depending on what instrument you chose. If you chose options, you'll have to take all these additional decisions. Okay, and if you chose futures, forward, swaps, you'll have to take the additional expiry decision. And what we will show you later on is, we're not going to spend too much time on this right now. We will do this later on when we do something called stack and roll. This is also mentioned in your textbook. So if you come across that, it basically, I'll just give you a brief idea of that, and then we'll move on. So stack and roll basically is that you look at this. Okay, so let's look at the example of futures and talk about what is meant by stack and roll here. Okay, this stack and roll over, this asterisk is against this one, okay, active. And this can actually be applied to this also. You can do the same thing for the options. And let's put a color coding on this so that you can understand which is the, although you don't really need color coding because you've got the one asterisk, but still making it easier to spot. With color coding, it's easier to spot. So stack and roll over, what does that actually mean? I'll just give you the brief concept, then we'll discuss the detailed examples later. Mainly what stack and roll means is that the idea of stack and roll comes from this, that if you look at this, if you look at the India exposure, let's say this is the layout of the India exposure. Now Feb is already over, okay? So the Feb contract is not there, so we can ignore the Feb exposure. So what we see, we've got 650 in March, and we got April, May, June. Okay? Now, one option, of course, is to take the individual exposures and hedge them, perfectly match the hedge maturity to the underlying position maturity. So you do 650 contracts for March, you do 750 for April, 350 for May, and 210 for June. Do we have all those contracts? Yeah. So you got March, April, May, June. You can do it this way. Okay. The other way to do it is that would be perfect matching. But the reason that we have called this an active decision, the reason that we have said that these additional decisions related to DP4, when there are these more complicated types of instruments being used, which you might have chosen here. Remember, choice of instrument is active. Choice of instruments is active by either the corporate board, which sets the risk management policy, or the hedging team, if they are given the flexibility. So this is an active decision, and this will have implications for your further decisions over here, right? So if you are using, let's say if you're using futures, one of the things you will do is, instead of hedging perfectly matched against each of the month's exposures, the underlying position, what you would do is you would look at this volume distribution. Look at the volume distribution. Obviously the most liquid contract is March. Okay, this is where the most liquidity is. So therefore, what you will do is, instead of hedging the exact amounts against each of the months, you're going to put the whole exposure into March. So what you will do is, when you have this, right? So we'll ignore Feb. Okay, let's ignore Feb for the moment. Make it a bigger, smaller thing, because Feb is already over. Okay. So this is your exposure. It's 2460. Yeah, okay, because we got the March, but we'll take out the. Doesn't matter. We'll take this. Here's 1960. Okay. So it's 1960 here, with ignoring the Feb, because the Feb is already over. So what you'll do is, instead of hedging 650 for March, you will actually sell 1960 March contracts. You will sell 1960 March contracts, and then what you'll do is, we'll discuss this later when we discuss the example. We'll make sure that everybody understands. Okay, stack and roll. What you do is you sell 1960 for March, and as the March expiry, how much is maturing in March? 650. So when the March maturity, when the delivery date comes, you will unwind the first position, first notice date. In the case of crude oil, you have to watch out for the first notice date, before the first notice date, you will unwind the hedge, and then you'll just buy at the market, because it will be close to the expiry. So what happens? You bought 1960, and then 650 is rolling off in March. Okay. So initially your positions are all in this case, in the case of India, the positions are all short. Okay, so we have to buy. This should have been written with a minus sign. Actually, these are all short positions in the case of India. So because initially we wrote it for Saudi Aramco, and then we started discussing India. So these are all short positions. So India's hedging team will be buying the futures hedges, going long on the futures as hedges. So hedge position has to be long. So they go long 1960 initially. All right. Now, and then in March, 650 of the oil is actually physically purchased on the market. So the hedging requirement, the underlying position disappears, because it is no longer uncovered, because the oil has already been purchased. In the case of the inventory, it's the equivalent of having, if they already sell this gold, once they contract to sell the gold to somebody, Tanishq or somebody, they sell the gold, and that's it. This exposure is no longer there on the books. All right, we assume that Tanishq will not default. There will not be a materialization of credit risk. So what has happened? We were short this amount 1960, so we bought 1960 contracts in March. But in March, as we take delivery of 650 barrels, 1,000 barrels of oil, this exposure runs up. So now what I'm left with is basically 1960 minus the 650. So I'm left with a 1310. All right. So what I will do is, initially I will buy 1960 as a full hedge, full 100% hedge, but not perfectly matched to the maturities. Then, as the March is expiring, and before the first notice date of March, you'll see that April will become the active contract. Right now, March is the active contract, the highest volume. Before the first notice date of this contract, this will become the active contract. So what I will do is, I will allow, out of my 1960 position, I will allow 650 to basically, what I will do is basically I've already long 650, right? So I will now, I will not be taking delivery. So I will close out 650 contracts. Okay. So I will essentially close out 650 contracts out of my position. And for the remaining 1310 contracts, what I will do is I will sell March and buy April. Okay, this is known as a future spread. It's an intra-market future spread. So we'll discuss that later on when we discuss the spreads. But right now, this is I'm just giving you the feelings. So what you do is you have two problems because you're not going to be taking delivery. So that 650 hedge, once your sales team has, once your purchase team for India has tied up the contract price for the physical oil tankers, so this exposure has disappeared because the IOC guys who are buying the crude oil, they have tied up the oil with the oil traders. They tied up the price for 650 barrels, 650,000 barrels. So this exposure is no longer there for risk management purposes because the price has been locked in the physical market. So therefore you need to lift this hedge. What was the position of the hedge? It was a long hedge because the position was short. It was a long hedge. So you have to lift this hedge. You have to therefore sell it. You have to square it off. You have to sell 650 contracts and square off this long hedge. But you're still left. Initially, you bought 1310 contracts. Okay. And now you will sell off 650. So you will be left with, initially you bought 1960. Then you will sell off 650. You will be left with 1310 contracts long for March. Okay. Now what you'll have to do is you'll have to do a spread transaction where you will do for an amount of 1310 contracts. You will tell the broker amount is 1310 contracts, and this is how the transactions are done. Okay, you will tell the broker that I want to do a future spread. What is my position in March? I'm long, right? So I want to do a future spread which is sell and buy March against April. Let's try to write this somewhere that we can talk about it. Stack and roll. Okay, let's explain this in the notes which we have. Okay, since we are discussing the stack and roll over. Okay, so how did this work? Initial exposure was what was it? 1960 was barrel is written like this. Okay. Okay, so before that, so okay, so I had exposure of 1960 barrels. Underlying position. And it was short 1960. Hedged by buying 1960 contracts for March. Why? Because each contract is 1,000 barrels. Okay. Now, maturing in March is 650K barrels. Lift hedge. I'll just write in capitals now. By buying, by selling. Lift means square the hedge. Lift doesn't mean going from the third floor to the fourth floor. Just squaring the hedge, okay? Square the hedge because this is no longer required. It's a maturing, so the sales team, purchase team has already bought this oil, locked in the price for this oil. You lift this hedge, so therefore this hedge has to be lifted. It's no longer required. So you square the hedge by selling. It was a long hedge, so you have to sell it by selling 650 contracts, okay? contracts for March. This part is done. But you're still left with 1310 because you bought 1960. You bought 1960 initially as a short against the hedge of this all these short positions, underlying positions. Now 650 has matured, you're left with 1310. So what you have to do now is, okay, you have to now do okay. Okay, now this is the stack part. Okay, what is meant by stack and rollover? Okay. Okay. You understand the word stack? The stack is basically you go to the library and you find there's a big stack of books on the desk. Okay, so anything put together in one heap, it's a stack. Okay, so what you're doing is instead of hedging against each maturity month, perfectly matching the maturity of the hedge to the maturity of the underlying position, instead of doing that here, month against month, each of those, you look at the asymmetric distribution of liquidity and you say, well, this is not acceptable to me. I don't want to be trading. I don't want to be hedging into these illiquid months. So let me hedge everything in the liquid month, which is the active contract. And therefore, I stack it. I stack the entire hedge into the front month. Okay. And that's why it's called stack. This is the stack part. Okay. This is the stack part. Now, where is the rollover coming? It's just called stack and roll, but actually it's a rollover. So I put this in brackets inside here. So now you understood the stack part. Now, as the months mature, each month's exposure matures off. What is happening in terms of India's exposure? What will happen is, as we get very close to this maturity, the purchase team at ONGC or IOC will be dealing with the physical oil traders who are basically dealing in tankers, etc. And they will lock in the price of the tankers by doing a cash market transaction, essentially. Okay, cash market doesn't mean value cash, but this is the underlying market, not the derivative market like futures. So they'll be looking at the futures, the physical market. There are many famous traders like Trafigura. Many of these guys are actually active in India. You can try to contact them for your placement and things like that. There are big oil traders like Trafigura. Then there is also, I'm trying to remember, they're all based in Geneva. They're all based in Geneva because Geneva is where the OPEC meetings are held. Okay, so this oil trading business, there's a big concentration of firms in Geneva. So there's Trafigura. I'm trying to remember. Anyway, there are some other names which are not coming to my mind right now. But anyway, so these physical traders, the government of India IOC will be contacting them and locking in the price. So this has matured. 650K barrels, price is locked in, it's matured. You need to lift the hedge, square the hedge by selling the 650 contracts which you had long out of the 1960. That's done. Now, need to maintain hedge positions, but March contract is expiring. Okay, so what to do? March contract is expiring. Therefore, you do now this is where the roll part of it is concerned. Okay, it is basically roll, and you can think of it as roll the stack, roll the remainder of the stack. If I write it like this, it'll be easier for you to understand. What you have to roll is roll the remainder of the stack. Roll means you push it, take a carpet, roll it, and move the location of the carpet. So this is what you're doing. You're rolling the remainder of the stack. What is the remainder of the stack? 1310. How will you roll it? What is your existing position? Okay, this is to be done by do what we call a futures intra market or inter-month. If you remember when we did these, when we did the discussion on futures, if you remember, we did this discussion a little bit. We talked about the different types of spreads. You can have inter-market spreads or you can have intra-market spreads. This is an intra-market spread because it is not moving outside of crude oil. But if I had an exposure in jet fuel, I showed you that chart. If I had an exposure in jet fuel and I hedged it with crude oil, Then my underlying position is, let's say, short for an airline in jet fuel, but my hedge position is long in crude oil. Crude oil is not the same as jet fuel. Jet fuel comes from crude oil, but the two are not exactly the same. So that would be an inter-market spread, because there are two different markets, INTER, inter. But this is an intra-market spread which we are going to do. Intra-market is also sometimes called inter-month, because we are going to be involving multiple months. So inter-months, intra-market. To get good practice for yourself, you can practice saying both of this together, so that it will reinforce in your mind that it is intra-market in the same market, but it is inter-month. Okay, so futures intra-market or inter-month spread. And how will we tell this to the broker? How do we give the order? Tell broker. What do you tell the broker? Need to. What is your position in March? Remember, you squared off 650. You had initial long position of 1960, and then you squared off 650 by selling off 650. So you're still long 1310. But this is no good anymore, because in March, because this thing is expiring, you need to get out of here. If you remain long 1310, you might get delivered on 1310 if you go past the first notice date in crude oil. So you might get delivered. You don't want to get delivered 1310 for March, because you don't need it until much later. So what you do before first notice day, you roll this. Do a futures inter-month spread. Okay, what you do is you tell broker need to, that is I need to, obviously. I need to, what are you going to do? You are long in March for 1310. You don't want the long position in March, but you want the long position in April. So the spread, remember, does not create a net position. So you are going to, you want the long position in April, so you need to buy for April. But since the spread, you know that the spread does not create a net position. So if you're buying for April, you must be selling for March. And that makes sense, because if you sell for March, the remainder of your March long position will go to zero. All right, so what you will do, we will tell the broker, notice your remaining position 1310. You will tell the broker need to sell and buy. Sell and buy March against April. Let's see, sell and buy which contract? CL. So please mention, when you mention CL, they know that CL is, this is the contract for CL. Okay, everybody knows that anyone who's trading any futures contract goes. You can just tell him NYMEX West Texas Intermediate Crude Oil Futures. But if you just tell him CL, that's fine. With a symbol, everybody knows what you're trying. Need to buy CL. This is for the indicating which market. Need to sell and buy CL March against April. Okay. 13, how many contracts? Let's look at that, 1310 contracts. Okay. Spelling of contract doesn't matter. All right, so this is what you do. This is how you do a futures inter-month spread. You tell the broker, I need to sell and buy. Let's make it nice and give ourselves a little identity here. I need to sell and buy. I need to sell and buy crude oil. Okay, CL, March against April. And this is how the language has to be. Okay, March against April, 1310 contracts. Okay, so this is basically a futures inter-month spread. And if you remember when we discussed margins, okay, when we discussed margins, you remember, you can cross-check this now, going back to the CME website. Here, if you go back to margins and check, you will find that CME charges you much lower margins for spread transactions. When you first hedged by buying 1960 contracts for March, this was an outright position. Okay, this is the outright long for 1960 for your hedge position. Okay, this is the margin. There's a margin system for that. But when you do, if of course this, you will still be left with a long position, net long position. But if you are doing, the point to understand, since we are discussing futures inter-month spreads, you should also understand that if this thing was existing in isolation, if this, you did not have the existing long position which you are rolling forward, If this was not part of a stack and roll transaction, if this was a standalone transaction, this margin on this transaction would be much lower than an outright long position. This is a spread position. It's not an outright position, it's a spread position. It has much lower risk. So the exchanges will charge you much lower margins for this kind of a position. Okay. But in your case, of course, because it is part of a stack and roll scheme, right? It's a stack and roll scheme for you. So therefore, right, let's put this like this. It's an important topic. So we are effectively discussing the whole thing, except that we are not doing the whole spreadsheet example. We can do that. You can practice it on your own. Maybe we won't have time to come back. But you got the whole scheme, right? It's all written down here, step by step. So there's no room for confusion. Right. So just to remember that this is when you're looking at this kind of transaction, if you were doing it in isolation with a spread transaction, you would have much lower margins because the risk is much less. And in this case, what happens is, what is the result? Okay. Post trade, okay. After the broker does your trade, okay, is equal to what? March position is 0, right? Result post trade is, let's look at it this way. March position, okay, I've written it, why waste my time? And April position is long 1310. Okay, so we'll explain how this happened. April position is long 1310 contracts. Okay, you can see here, it's not mathematical, but you can see it visually itself. So first you open a hedge position by buying 1960 contracts for March. Then you will adjust this in 2 steps. As the March is maturing, 650K, you will need to buy back 650K of the contracts for March. That leaves you long 1310 contracts for March. You don't want that because March is maturing. The contract is expiring. So you have to roll this position from March to April. How do you roll it? You do roll it by doing a futures intermonth spread. So you call your broker and you say, I need to, for CL, I need to sell and buy 1310 contracts March against April. Okay, so the broker does it, and then you end up with a position. If you sell and buy, that means you're selling 1310 in March and you're buying 1310 in April. So since you had a remaining long position of 1310 in March, okay, and now you're going to buy, that is squared off, okay, that goes to 0, and then you're left with 1310 contracts position, long position for April. Okay, this is what it is, okay, this is what is meant by stack and roll. So this thing is known as stack and roll. So this is what a lot of people do, because the main motivation for this is that, yeah, anybody has a question?
Yes, sir. Sir, in this, do we have higher transaction cost rather than if we buy certain contracts differently for different months? Like, because here we are buying a contract, all the contracts for March, but sir, in the later months there may be liquidity for June and July also. So if we rather than buying all the contracts 1310 for March, if we buy 650 for March and then another for April, wouldn't the transaction cost be lower in that case?
Yeah, so what you're suggesting is that basically we perfectly match the maturity of the hedge to the maturity of the underlying position, okay?
Yes.
So obviously if the liquidity is fine, it also depends, remember, that it also depends on the kind of hedging program that you're running, okay? So if you remember that there are two ways to run the hedge. We have not had the discussion fully on this yet. But the point is that you can, there are basically what we are talking, where is the note here for us? Here. Okay, so yeah, see, this is 100% hedging part. Okay, let's look at it. This is where we are talking about hedge and forget. Okay, so in this discussion, we are assuming that there is a static hedging program. Okay, we are assuming that the static hedging program. So there is still a liquidity. But there is also let's discuss the hedging program, which we are going to discuss later. Static versus dynamic only means that in the case of a static hedging program, once you have this exposure of gold of 2,500 units, once you decide to hedge, you just straight away hedge it once. You sell the underlying position long, you sell 2,500 ounces, okay, which means you sell basically this is 25 contracts. So each contract is 100 troy ounces. So you sell 25 contracts, and that's it. You forget about it. Now you know your gold position is hedged. You're not going to disturb it anymore. So the point is that the point of the static program is this: that if you let's say you sell gold here, okay, you feel that it's going to go down, and you sell gold here and hedge the whole thing by selling 25 contracts, let's say at 1860 or something. Then the price goes down to 1600, okay, and you feel that it now at this point it may actually rise all the way back to maybe 1780 or 1800, 1780 or 1760 or something like that. But even though you have a strong view, the market has dropped from 1840 to 1600, and you sold at 1840, so you're sitting on some profits on the hedge position, and you have a very strong view that the market is now going to bounce back to 1770. So 1600 to 1770 is quite a big bounce, okay? But the point is, because you're running a static hedging program, you are not allowed to do this. This is why it's called a hedge and forget strategy. So even if you have, there's a long time to go for your hedge. Okay, the majority of the hedges underlying position is quite far away, and you see the drop, and you have a strong view that it's going to turn around and rise quite rapidly. However, still, because you're in a static hedging program, you're not allowed to disturb the hedge. You have hedged at 1840, now forget it. It's over. Okay, wait till the hedge to come to mature, underlying position to come to maturity, then lift the hedge. Okay, unless you're going to take delivery. In this case, you use the hedge position to take delivery. So that is what is meant by a static hedging program, even though you have a view that your hedge position will now start losing money. Because see, from 1840, when it dropped to 1600, your hedge position made a lot of money because you went short in the hedge position, okay? And the underlying position is losing money, but the hedge position is offsetting that loss. But now you feel that it's going to bounce from 1600 to 1780, okay, 1770. That's a very big bounce. Your hedge position is going to give up all this profit. Okay, but because it's a static hedging program, you're not allowed to play on this view. You're not allowed to do anything to execute, to give effect to this view. That is the meaning of a static hedging program. Now, if you are now running a dynamic hedging program, which we have not discussed here, but what you guys will be running, in the case of this theory, I just wanted to keep it simple, so I have assumed static hedging program, okay? But in fact, you guys will be in your project running a dynamic hedging program. What is a dynamic hedging program? Which means you actively give effect to your view, which means now you hedged gold at, since the maturity, underlying position is a very far away maturity. So you sold at 1840, and then the prices dropped to 1600. Your hedge position is showing a big profit, offsetting the loss on the underlying position. But now you feel strongly this is going to rise to 1770. So then what you would do is you would again unwind the hedge. That means you sold, let's say, 25 contracts here. And let's assume that you're always trading for 100% of the position. Okay. So your underlying position is 2500. And so you sold 25 contracts. So every time you do a transaction, you do it for 25 contracts because the full underlying position. But it doesn't have to be that way. But again, to simplify things, we are assuming that. So in a dynamic hedging program, what you will do is, as the prices drop to 1600, you have a view that it's going to rise quite dramatically. Then you will square your hedge. So your hedge position is short 25 contracts, and at 1600, you have a view it's going to turn around and move up sharply. You will buy back the 25 short contracts. So your hedge position will go to zero. Okay. So your underlying position, think about the numbers here. Initially, the underlying position, since it's a very small thing, we can do it on our own. Initially, the underlying position is 25 contracts long. Your hedge position is zero. Okay, so if we can do it, we can do it here. Okay, let's do it here. If today is, how are we calling it? Are we putting it this 129? Yeah. Okay. So you have your UP, and then we may have to set it up somehow, the HP. Okay. So the UP is 25. Okay. So initially the HP is minus 25. Okay. So the TP is right. So we always connect by this goes to zero. Initially, when you sold at 1840, okay, 1840 you sold at the price, hedged at 1840, the TP is zero. Now, when the price goes to 1600, okay, what you do is this always remains the same, right? So this 25 was always the same. Let's assume that for all scenarios it's the same. 25 remains the same. This is a dynamic hedging program we're talking about, okay? In the case of a dynamic hedging program, and this part I'll just copy from here. Okay, it is already there. I need not have written that also. All right, what are we doing in a dynamic hedging program? When it goes to 1600, my view is that it's going to turn around and move up sharply. So what I do is somewhere here, okay. I'm going to turn around at 1600 or turn around. So therefore, I will implement this in my view, in my hedge position. So you see everything, this is just bearing out my statement, which I keep making from time to time. Why are we teaching you all this trading in financial markets, buying and selling spot equities, buying and selling options, and now doing a hedging? Why are we making you do all these live trading projects? Because every job you have in finance is going to involve taking views on markets, and taking views on market, there is no clear-cut answer. All right, so it is a very, very nebulous thing. It may be right, it may not be right. You can see what's happening in the markets. Everything's going up and down, lots of uncertainty. There are no clear-cut answers. So therefore, you will have to take a view. And so again, once again, what you do is, based on your view in the hedge position, you convert the hedge position back to zero. That means you buy 25 contracts. You were short 25 in the hedge book. You buy 25 contracts. All right. So the TP goes back to this. Okay. So the TP goes back to 25. All right. And then, of course, you have booked a profit over here. You can keep the hedge P&L over here. I'm not writing it, but you can keep a column for the hedge P&L. You just made a profit. You realized a profit of 1840 minus 60. So 1600. This was short. Okay, so the position is short. 1600 exit price. Remember, P&L formula is exit price minus entry price. So 1600 minus 1840. Okay, the P&L, we can do it here, is equal to, if you remember, position size into exit price minus entry price, and that's your P&L. So you made $6,000. Okay, so looks nicer if you put the commas. Okay, so you made $6,000. Right. So this is your realized P&L. Okay, you have closed the position, but the problem is the TP is now opened up and gone to 25, which means your underlying position is exposed. So the risk of doing this is that, well, you had the view, you thought you were a great trader, you had the view that it's going to bounce from here to 70. What if it doesn't happen? As soon as you lift your hedge, you square off your short 25 contract hedge, immediately the market collapses to 1200. Now what is the problem? From 1600 to 1200, you have to watch if it goes to 1200. Now this entire 25 contracts, okay, $400 on the 25 contracts you have lost. This whole thing is being recorded on the underlying position, and your treasurer's CFO is going to come and tell you what happened to you. You thought you were so smart. You lifted the hedge, and look how much money we have lost. $400 into 25 contracts. Okay, you can calculate that. 25, in this case, underlying position times exit price. Because remember, why is 1200 the exit price? Because there is a continuous mark to market. When the market drops to 1200, the underlying position is going to be marked to market at 1200. Okay, the accountant is sitting there. He's always going to apply the market price. Remember, lower of cost or market, conservatism concept. Okay, and also true and fair accounting, because you have to give a true picture of the nature of state of the business. And it is the true fact. I mean, the fact is that your inventories are now only worth $1,200 per troy ounce. Okay, so that must be reflected. So therefore, that's your exit price. exit price minus, and where is the entry price? Actually, the entry price is going to be here. When you started the hedging program, it's going to be this. So you will lose this entire amount because the hedging program will be benchmarked against that. Okay, $16,000. But against that, you have got this one. You have got a profit realized of 6,000. So your total P&L will be net of these two. Okay, but your initial mark to or the entry price will be considered at the start of the hedging program, or whatever is the budgeted rate. Okay, so we can have more discussions on this, but for underlying position, the entry price for the underlying position is actually considered generally you would consider the budgeted rate, okay, against which your hedging efficiency will be measured. All right. So I've had a long discussion on, so this is what happens, okay, if this happens, okay, if it drops to 1200, this is the risk of doing what active dynamic hedging program. But if it doesn't happen, if your view is correct, it goes to 1775, then you again go to 1775, you can redo the calculation. You again hedge at 1775, okay, again at basically what you do is at 1775. Now this is not to be seen as a continuation, okay. Well, in that case, we should put 1775 here, okay? And we will not write this P&L here. Okay? If you go to 1775, now you squared off the position 1775. Again at 1775, you will go minus 25, okay? Again, you will make the total position 0 by, you hedged it here, made the total position 0, market dropped here to 1600, because here I'm only trying to show you what is a dynamic hedging program. Okay, so you hedge first 100% at 1840. Market drops to, your underlying position is long, your hedges are short. Market drops to 1600. You have a strong view, the market will rise to 1775. You implement your view, you square off your short hedge, make the hedge position equal to 0. The total position becomes exposed. The total position becomes, initially it was, total position becomes 25. But then the market rises to 1775, and there you hedge again. You sell the full 25 contracts, and again the total position goes to 0. And again, maybe this thing drops to, this time it drops to 1500. And again, you have some kind of view that it's going to jump, and then again you square it, and then you re-hedge it again at lower levels. So basically what happens is, if you can do this successfully, okay, if you can do this successfully, you will obviously show a net profit on this, and it will be a profitable program. Okay, if you can, but of course that's a big if, because as I showed you, you're also taking a risk that as soon as you lift the hedge, the market collapses. You never know what will happen in markets because they're highly unstable, as you have seen in what is happening in GameStop and a lot of the other equities, and it can happen in currencies, commodities, everywhere. There are very frequent gaps in the food grain complex: wheat, rice, corns.
It's called a short squeeze, right? That GameStop thing.
Yeah, the GameStop thing is a short squeeze. Okay, it's a short squeeze. So we'll come to that. We'll discuss that briefly at the end of the class. Right now, I'll just discuss this. But you're correct. That's a short squeeze. Okay, good that you heard these terms. That's good that you guys are starting to look at the market news and things like that. Okay, so we're still answering Siddharth's question, but I am just, I wanted to give the distinction between dynamic and static hedging program, which has already happened now. This we would have had the discussion maybe sometime later. So now you understand what is meant by a dynamic and static hedging program. Okay. Now we can answer Siddharth's question a little better, because what Siddharth is asking is, wouldn't it be better to just hedge everything, since you know you have certain exposures for April, May, June, July, etc. And there is, according to him, there is a sufficient liquidity in these months also. So why don't we just hedge against these months, okay? So that the hedge maturity is perfectly matched to the underlying position maturity, and we don't have to do the stack and roll business, the rollover business. So he's correct, okay? If your underlying positions are such that they are only in short dated maturity, then there is sufficient liquidity in those futures months. And especially if you're running a static hedging program, okay? Because I have to teach you about stack and roll, because in futures trading, you have to understand, in hedging, you have to understand what is stack and roll. So I have to teach you what is stack and roll. But Siddharth's point is especially correct, okay, is more correct if you're running a static hedging program, okay? So basically, we can write this as a response to his questions. They're topical questions, so we discussed it in this itself. Okay. If one running a static hedging program and two, there is sufficient liquidity in the respective futures contract months for which there are I want to write underlying positions. Is there anything written here? Okay, I'll just write it. Okay, for which there are underlying, if there's sufficient liquidity in the respective, so if two, basically, if one and two. Okay, it could be, maybe it's and or two. But I think this is better. I think both, if you do this when you have both, only then it makes sense. Okay. And, then stack and roll does not make sense. Okay. This is the point of Siddharth's question, basically, which is a good question because he brings out this point. Stack and roll. Okay. So writing don't, I will say, don't do. Okay. Okay, don't do. Okay. So, because, just to save my writing, so stack and roll doesn't make sense because you're running a static hedging program, which means you're going to hedge and forget, and there is sufficient liquidity in the respective futures contract month. Let's take this example that we have, because the example there is, yes, Ketan? You had a hand up.
Stack and roll is static or dynamic?
So stack and roll itself is not static or dynamic. Static or dynamic is relating to the hedging program. Okay, so it basically static or dynamic is a function of how your corporate board has written your risk management policy document, whether the hedging team is allowed to run static programs only or are they allowed to run dynamic hedging programs. If they're only allowed to run static programs, that means they hedge it once at 1840. Let's say they are long gold in the underlying position, and then the hedge will be a short hedge. So they sell 25 contracts at 1840, and then the market drops to 1600. So even if the hedging team feels it will rise to 1775, they can't do anything about it because once they have hedged, that's it. They can't touch it anymore. Then they have to wait for the maturity of the hedge. When the sales team tells them that, okay, guys, we have already closed out a physical contract with Tanishq to sell this 2,500 troy ounces of gold. Now you can consider the underlying exposure as having been squared off. So underlying position goes to zero. Now the total position has become minus 25 because the underlying position has gone to zero because the underlying position has already been sold off. So now your job as a hedging team is to, again, you have to reduce the risk and you have to basically square off this hedge position because it's no longer required now. Because the underlying position against which it was a hedge has been squared off. This has been sold in the trade. Okay. There's some background noise, just ignore it. So therefore, this is what is meant by static hedging program. Is this clear, Ketan?
Yes, sir.
Okay. Static hedging program means hedge and forget. Once you hedge, you can't touch it until the underlying position has rolled off. Then, of course, you have to touch it because you have to square it. But you don't get to play with the hedge. You don't get to implement your market views, sophisticated market views. But if it's a dynamic hedging program, as I showed you, you play with your hedge position, you keep squaring and you can keep hedging, unhedging as many times as you want based on your market views. And if you're correct, of course, you can make a lot of money, more than if you did just a hedge and forget. So this is the so hedging, dynamic is hedging means that if you go hedge it here, short, sell 25 contracts, it goes here, you have a view that it's going to bounce, square it off. Buy back your short hedge of 25, go to zero hedge position. Then wait for the bounce, it comes here, and then you sell it again, it goes down. Again, you buy back, you see a bounce coming, you buy back, goes up, 1650, then you sell it again. So you keep buying and selling based on your market view, keep adjusting your hedge position. It keeps going from, total position keeps becoming fully unhedged, fully hedged, fully unhedged, fully hedged, fully unhedged, like that. It keeps bouncing as you keep playing with your hedge position. But of course, remember, this is very dangerous because you may, as soon as you unhedge, they may drop, the market might drop to 1200. In that case, you're in big trouble because your underlying position will lose all this money, and there is no offsetting hedge position profit because you squared off the hedge position. You were so smart. This is dynamic hedging program. This is a dynamic hedging program. Is this clear now, Ketan? This too is clear.
Yes, sir. Yes, sir.
Okay. So when we say static versus dynamic, we are not referring to stack and roll per se. Stack and roll is a type of transaction strategy or a hedging strategy, but it is not related to static or dynamic. It is something that you can do, but as we shall see, makes more sense when you're doing a dynamic hedging program. But static and dynamic is only relating to referring to the manner in which you conduct your hedging program, what you're allowed to do and not allowed to do. Whereas stack and roll is a type of a transaction pattern, basically. All right. So stack and roll is, and so basically what Siddharth is saying is that, so if we have two things are satisfied, if what Siddharth is saying is, why not? Because we looked at India's positions and what did we see? Positions are in March, April, May, and June. 650, 750, 350, 210. Maximum position is 750. Let's look at the prices. Let's look at the volumes. Okay, these are all contract based. Okay, so 4,136 means actually it is volumes of 4.1 million. Okay, so if you see 750 is our maximum position. So March, April, May, June. That's all we have. Yeah. March, April, May, June. In all the months, we have minimum, we have more than 750 volume. Okay. I'm sure we can also look at the open interest, but volume is good enough actually. So it's well over the exposure. So why not just hedge now and do it? Okay. So he's correct that if that's, but obviously the exposure in real life will not be only for till up to June. It will be much longer because India will be buying oil even after June 2021. Okay. So if you're hedging oil for India, you will be running at least a 3-year or 5-year horizon. Okay. So we'll be hedging purchases for 3 years or 5 years or something like that. But if it is true that it is only for up to June and you see there's enough volume here, just you'll have enough liquidity in the contracts, just go straight away, take the exact maturities. So June you have 210. So what is Siddharth saying? Instead of buying everything for March, buy 210 for June. See the position for May, might buy the exact amount for May, April, right? And this is the perfect hedge and forget, because once you do that, then you don't have to worry about your risk. You don't have to do any stack and roll business. Everything is covered. So he's right. I just want to come to Mithali. I just wanted to point out what Siddharth is saying is correct, but it makes more sense when you're running a static hedging program and there is sufficient liquidity in the contract months for which there are underlying positions. Okay, both of these are true. If there is sufficient liquidity, it means that you will get good prices. You will not have a high bid-offer spread. And the prices will be generally quite good because the bid-offer spread will be tight. You'll get close to the, you'll get a good market price.
So also as we approach later dates, the liquidity is also going to increase for I think for July and August.
Yeah, it will also. But if you're running a static program, it will again also not matter at all. What will matter is basically the initial price is a good price because the bid offer spread is tight because there is high volume. Okay, that is basically what is going to matter. So in the oil contract, so this is basically the point. So what Siddharth has made is a good point to understand that if you're running a static hedging program, the second condition is also satisfied, then there is no need to do stack and roll. It does not make any sense. It is better to, so let's do the alternative, and better to perfectly match maturity of hedge and underlying positions. Okay, hedge positions and underlying positions. We can copy this. That is what Siddharth is suggesting, that why don't you perfectly match the maturities of hedge positions and underlying positions, look at how much you have for May, buy it against May, don't buy the whole thing for March, and then do this. And so it's correct, and it's especially if you have a static hedging program and very good liquidity, sufficiently good liquidity in those months, you can do it, and then it makes sense. Then do not do stack and roll. Okay, don't do. Let's put a little gap between there. Okay, all right, that's the point. So of course, my objective was to introduce you to stack and roll. So I took that example and I forcibly did stack and roll. So, but he is right about that. Now, so why do people do stack and roll? Because usually the exposures run for many months. You see that there are exposures, and if the contract volume is not high in this August 22, September 22, there are zero volumes in some of the other future months. So the reason that people do stack and roll is usually that for most businesses, they will be looking at a 3-year, 5-year hedging horizon. Because say, for instance, there is an airline in Europe, a regional airline called Ryanair. Since you guys are now looking at all kinds of market activity, you can do a search on Ryanair hedging strategies, crude oil, jet fuel hedging strategies. So Ryanair is an airline, so you have to figure out that for an airline, since they need to buy crude oil, their net position is short, their underlying position is short jet fuel. So they will have to, and they hedged typically for 3 years or 5 years. Okay, so that's why people do stack and roll, because usually their hedging horizon is very far away, very long. Okay, very long hedging horizon, and there isn't enough liquidity in certain contract months. So that's when the stack and roll strategy makes sense. And also the other element where it will make sense is where you're practicing a dynamic hedging program. If you're doing a dynamic hedging program and you're frequently changing your hedge position, you're frequently hedging and unhedging, then you need to remain in the most liquid month. It is best to have your entire position in the most liquid month, because there you will get the best liquidity, best prices, and that makes a difference to you because you're frequently hedging and unhedging. Okay, that's the point. So does that answer your question, Siddharth?
Yes, sir.
Okay, so it's a long answer, but it's a good question. We needed to understand this, so we will. So we went through. Now, with Mithali, what is your question?
Sir, it is answered. I was about to ask that why will we do stack and roll over?
Yeah, so it's already answered. So it's basically because of the situation. So if, like, say for instance, Ryanair has a 5-year position, and they are trying to hedge 5 years worth of monthly deliveries or 60 months of deliveries of jet fuel, and they are trying to hedge by buying crude oil futures, then they see that there's not enough liquidity in all the months. So they will follow what I showed you in stack and roll. They will buy the whole thing, they'll stack the whole thing in the front month. They will buy the whole exposure here. And as the months roll off, they will keep on, they'll square off what is there rolling off in that month. And then they'll do a inter-month spread and push the position to the next month, and then so on and so forth. So this is a useful thing. Since you're studying risk management, it is important for you to understand what is meant by stack and roll. All right. So this is called stack and roll. So which basically shows you that the whole point of the stack and roll discussion is that it comes in what kind of context? In this kind of context where you have the buy-sell decision. We are expanding on the DP4 buy-sell decision. When you're trading certain types of contracts, there are additional decision problems related to these factors: expiry, strike price, call put, style of exercise. Now, in the case of futures, we are talking about expiry. And so what you see is that expiry is an actively solved decision problem, because you have a choice. You can either do full hedging, you can either do perfectly matched, as Siddharth was suggesting, okay, perfectly matching the, perfectly match the maturities of, so these are two alternatives. Stack and roll is one alternative, the other is to perfectly match maturities of hedge positions and underlying positions, okay? So that is the other way of doing it. Where was I? I got a little bit lost. Yeah. So that's why we say that the expiry, what is the whole point of the discussion? Where did it start from? Because I wrote active against the expiry decision. Why did I write active? Because you do have a choice to make. You do have a judgment call, okay? Where basically, do you want to do stack and roll, or do you want to perfectly match the maturities? This is a choice. This is a decision problem. You can either decide to do this or decide to do this. Okay, or you can do this for a while and then switch to this. But at a point of time, you're choosing between one of the two. These two are mutually exclusive at a point of time. All right, for a certain for the same underlying position, these two are mutually exclusive decisions for at a point of time. So that's why we say there is a decision to be taken. We choose either one alternative or the second alternative, and that's why this is written here as active. This is an active decision. Okay, it is not automatically solved. That's why we write that. Okay. Now,
Sir,
yes.
sir, about the dynamic hedging program, sir, if it increases our total risk, sir, how is it a hedging? Because, sir, in bidding to save our losses, we are actually incurring losses. So it would be ironic. So, sir, how is dynamic hedging actually hedging when it increases our total risk?
No, remember that that's why if you remember, what is my definition of hedgers? If you go back to the
Overall risk.
No. If you remember my definition, that's why I chose my words very carefully when writing definitions. What does the definition of the hedger say? Remember?
To minimize the risk.
No. That's not
The
what.
the first position is to minimize the total risk.
The first transaction
Yes,
minimizes
sir.
the overall risk.
Correct. Not first position, but first transaction. Okay? Or you can say a position will result from a transaction. First transaction must reduce the total risk. I did not say every transaction. You notice this? If you go back to your notes here in the notes file, there is your additional notes. Types of players in financial markets, please read this note. You'll see a detailed discussion of hedgers, speculators, and all these people. My definition of hedger is first transaction must reduce the total risk. Total risk is defined as UP plus HP. Only the first transaction has to reduce total risk, because with the first transaction you cannot, this will lead you soon to the golden rule of hedging, which we'll come to, which we have already discussed briefly. So now you understand, Siddharth, what I was saying? It's the first transaction which has to reduce total risk. The subsequent transactions, you see here, the total risk has gone up because you did a short hedge at 1840 and you squared it at 1600. So now your underlying position remains the same, but the hedge position has gone to 0. So the total position went from 0 to 25. Okay. But this is the first transaction. The first transaction did reduce the total risk. The total risk initially was, in fact, ideally there should be a row over here which shows, if we put a row here, it shows the underlying position as 25 and the hedge position as 0. And so the total position is same as this here. So this is how you start, okay? And do you understand? Now this is your first transaction. Is this clear, Siddharth?
Yes, sir. But sir, in case of second transaction or third, when we have a zero hedge position or a hedge position, when when our view turns out to be wrong and we are losing more money, instead of making, so sir, our overall P&L would be in negative. So
Yes.
that's also.
P&L is different from risk. P&L risk is reckoned in terms of your underlying position exposure. Okay. So the risk is, basically the risk is proxied by your underlying position exposure. So that position exposure, in this case, has not, in the sense, only the first transaction has to reduce risk. Okay. Which is for this definition is satisfied. The first time, why did I write the definition like that? Because I know that there are certain types of programs like dynamic hedging program where if I write all transactions must reduce total risk, that definition will not hold true, because in a dynamic hedging program, you can increase the risk subsequently, total risk, by unwinding the hedge, squaring. But you're absolutely right. That's why I said this is very risky business. Doing a dynamic hedging program is very risky because it almost goes against the philosophy of hedging, because it exposes the company to risk. But still people do it. Okay, so you're right in that way. But we reckon the risk as we are coming to Ketan. We'll come to Ketan. Okay, so you reckon the risk as So you reckon the risk as as being proxied by the total position. Is this clear, Siddharth?
Yes, sir.
Okay. So now I will just come. Yes, Ketan, what is your question?
Does it mean that if only first transaction is hedged, then it is dynamic, and if all are hedged, it is static?
No, I would not say that. I don't think that statement is correct. You understand the static and dynamic programs as what I have explained. You can go back
Yes,
and
sir.
listen to it.
Yes, I will.
These
Understood.
are rules as to what you can do. Okay. It's like basically, it's like if I say to you that you're playing cricket, but you can only take singles. You can't hit the ball and take 3 runs. You can only take singles, which means either you hit boundaries or you take singles. You can't hit, I suppose it doesn't go to the boundary and you run for 3. You can't do that. I'm putting a ban on that. This is clear. So it does not affect how many runs you score, but it does affect the fact that you can't just hit a shot of the boundary and take 3 runs, because I'm not letting you take more than singles. Okay, it's like a rule. All right. So,
Okay, sir.
and the hedge position, and you understand the hedge position, that's why I've written the definition like that. First transaction reduces total risk. Okay, the first transaction has to reduce total risk, which is done over here. Now, understand also, now there are a couple of other problems because we're going to finish the class very soon. Let me clarify. I had actually said that you will start your project. This is not going to be possible. Okay, I have to still do one more. We will start the project a little bit later, so don't start because our next class is not before 1st of Feb, I think. Okay, so I think we can't start it here because I haven't given you the full framework yet. So we'll have a shorter than 4 weeks project. Okay, but anyway, can't help it. We'll have to do that because we haven't covered the project material. And then we also have so we'll do that. Now, I'll just quickly, it seems like we're almost there, but I'll just give you a quick introduction to the golden rule of hedging. Look at this pattern. There's a note there, read the note, the golden rule of hedging. Okay. The golden rule of hedging, I'll just briefly introduce the golden rule of hedging. I'll just briefly introduce that and then take you back. Your total position has to remain, understand what I'm saying here. You can listen to it again on the video, read the note, and understand the golden rule of hedging. We'll cover it again in the next class. The total position has to hedge plus this has to remain between 0 and the initial amount of the underlying position. This all is written in your note. No need to take notes. This is all written in your note here. Go there and look at where is the discussion about the golden rule of hedging. Yeah. Project goal, hedging logic, and golden rule of hedging. Please read this to get an idea. The basic golden rule of hedging is bottom line, nothing but it has to remain between 0 and the initial amount of the underlying position. Okay. Total position must always remain between these 2 bounds. Okay. And of course, if the sales team tells you, the production team tells you that, guys, please take note, our inventory is now not 2.5K, it is 19.5K. So then you have to quickly update this to 19.5K. And then the rule will again be either has to be maximum size of total position is 19.5K or it is minimum size is 0. So always between the true underlying position and the limit of 0. Your total position must remain within this range. Okay, so I've taken 1 minute and 37 seconds. This is known as the golden rule of hedging, which, as I told you earlier, the JP Morgan case, those guys oversmart guys in the London, chief investment office, they broke this rule. And that's why they ended up with $6.3 billion in losses. Okay, so it's a very important rule that maintains some kind of, even if you're running a dynamic hedging program, you will, if you stick to this rule, there will still be good risk control, because as you go, remember, Siddharth, that if you unhedge at 1600, okay, you hedged at 1840, unhedged at 1600, you see market collapsing, you don't have to sit there like that for 5 years. As you can see, the market keeps collapsing. Maybe at 1560, you can realize your mistake and, cover yourself, go short again. So you're losing only between 1600 to 1580. Got the point?
Yes, sir.
Okay.
Yes, sir.
So the class is dismissed now. All of you can go. But if you have a substantive question, if you have a conceptual question, we can ask it. And is Vipul there? Vipul's not there today. Okay. So that I'm having a problem resetting the account.
Yes, sir, I'm there, sir.
Okay, I'll come to Vipul later. But is anybody else having a problem with their account? Account balance is very low.
Yes, sir, mine.
Ketan also has a problem. How low? What is your account balance? Okay, let's first see. Let's stay on there. Ketan, anybody has an account balance problem? If the balance is very low, please stay on the line, and I'll dismiss the rest of the class. But if there anybody has had the class is dismissed, whoever wants to go can go. And does anybody have a substantive question? Then
Yes, sir. Sir, the GME one.
Yeah, your GameStop question. Okay. So
Yes, sir.
do
Yes,
I
sir.
have permission to discuss the question with the whole class to show you?
Yes, sir, you can.
Is that okay?
Yes, sir, sure, sir.
Yes, sir.
Utsav has given this question. We will put this in the. Okay, so it's good that first of all, good that you and Sachin and hopefully some of the other people also are aware of this problem. Okay. Session notes. Yeah. Okay. So GameStop problem. This is the second thing we are discussing. Okay. GME. Okay. So let's take this. You guys have some class at 11:15. Ketan, Vipul.
Yes, sir.
Okay, okay. I better release these guys quickly. So, Utsav, I will do this a little bit later, okay? But you have asked certain questions, so let's try and address this later at some other, or maybe we'll have a tutorial or something like that. Okay, so maybe we can have a tutorial and address this. All right. So, but the basic thing is that. Yeah, so this basically shows you how unpredictable markets are. Okay, so you can just check. We will do this. The discussion is going to be quite long on this. Okay, so you have to, but it's good that you're following it. We don't have time. We don't want to hold back the other guys. We will have the discussion later on. Maybe we'll have one of the tutorial sessions on this. Okay, Utsav? All right. So we'll have to handle it later.
Sure, sir, sure, sir.
We don't have time right now. So
Okay,
let's
sir.
talk to the. So I'll stop the recording now.